Money day, guys and girls. Hope you lot are blessed. You're now tuned in to Learning with Vel. Today I want to share with you guys why it's really important to understand the significance of interest rates as well as inflation. So within this video, what I'm going to be doing is sharing with you guys not just the importance by maybe breaking down what's happening inside the world of finances, but also going onto the charts and showing you guys what I look for, and of course versus what you guys should be looking for when we understand what the interest rates as well as inflations mean to the world of Forex. So with no further ado, of course, take some notes, sit back, relax. If you haven't subscribed already, smash that button, bro. Like, subscribe, you know the vibes. It's lit side. Okay, guys. So, as always, we want to start by understanding what's happening within the economic calendar. Now, I use investing.com. You guys can use Forex Factory, FX Street, or my FX book. Whichever one is fine, as long as you've got an economic calendar to understand what's taking place throughout the week. You are going to be able to understand what pairs are going to be more volatile than others. Some of you may be trading at the moment and realize that it's been 4 or 5 days, in this specific trade and it hasn't moved. Well, the shock horror, guys, is that within the Forex market, just because the market's open Monday to Friday, that doesn't mean that every single pair is moving at every moment. Okay, these large institutions are only trading specific pairs at specific times at specific prices. So with that being said, I do want to encourage you guys to get access to my Telegram community. There I will be providing you guys with not only information regarding how you guys can understand more of the financial economical side of things, but also providing you guys with trades and an insight to what the institutions are doing. We call these financial institution orders. It's very important. If you guys can identify that, let's say there's a huge order for 500 billion euros, right, for Euro USD at price 1.062 and price is currently at 1.070, then you understand that when price comes down to that level, we're most likely going to see a huge reaction from there. These things are important because what I'm showing you guys is that you want to learn how to make money in the markets by not having to look at the markets. Sometimes the biggest and the best trade comes from you reading information. It comes from you understanding things. It's all well and good us watching Netflix and watching loads of inspirational movies. One movie I would recommend is The Big Short. Okay, we all know The Big Short, played by Christian Bale, my guy, Batman, and he plays an actor, Michael Burry, who pretty much reads reports. That's what he does. He reads reports and he basically understands that the housing market is going to collapse in America. And based on that, he creates a massive shorting option, which has been unforeseen, unparalleled. No one's ever mentioned this before. So he goes around to a bunch of banks saying, hey, I want to short this. I want to create a short option. Everyone's like, you're insane. You're going to lose all your money. Long story short, this guy's pulled off one of the best trades of the year. He sat in drawdown for triple-digit millions, okay? Triple-digit millions. I believe it took him over 15 months. I could be wrong, okay? So don't quote me on the time, but the film is very inspirational. You have to watch it. It's featuring huge actors like Margot Robbie. And what he basically does is he tells you guys, what the underlying message says is that patience is key. Sometimes you might read something that's actually a huge indication that will take place further down the line. So it's really important, guys. And like I said, today is going to be an educational lesson. It's going to be a good class for me to be able to provide you guys with some value. And one of the major things, or one of the only things that's important, I guess, at this precise moment in time is understanding what's happening in America. Why? Because America is the world's reserve currency. America right now, and has been for some time, the world reserve currency. So anything that takes place in America can have a knock-on effect around the world, which is the reason why we need to understand what's happening over there. Because if we can understand that, we can get ahead of the domino effect, rather than us falling victim to finding out that we've gone to our banks and the banks have told us our money's gone. If we can understand the source, then we can prevent us being bit on the other end as a consumer. So on Wednesday, we've got core CPI. CPI stands for Consumer Price Index. That is another word pretty much for inflation. So what's happening on Wednesdays, we are going to see the inflation results released. Now, I've highlighted 3.4%. Reason being is because last month, the inflation reports was at 3.5%. Okay? They are targeting, Chairman Powell did target 2% as his inflation target. So with that being said, you can see if this forecast from the analysts is correct, we will be heading towards a reduced interest rate and a reduced inflation. Okay, a reduced inflation and interest, they work hand in hand. So essentially right now, this is just for inflation. So I'll say to you guys that with this result being positive, or should I say with this result of 3.4% coming true, if it does, that would be positive for the United States economy. So as we move on to Thursday, we can see we've got GDP for the Japanese yen. We've also got jobless claims for the United States dollar. And then on Friday, we've got the CPI. Now, I told you guys already, the German economy is the most important economy. So because the German economy, the Germans, is the best, or should I say is the most important economy within the euro, we need to really know what's happening in Germany first before we hear about the Eurozone. And that's the reason why Tuesday's report comes out first for Germany and on Friday comes out for the Eurozone. So we'll stay tuned and we'll have a look on the charts to see what opportunities we can find for that. But of course, it looks like the rate may remain the same. All of these central bankers, if you guys can remember from the times of lockdown, they came out painting a fancy picture saying that these guys were going to reduce the rate of inflation. So to do that, these guys have talked the talk. Now they need to walk the walk. Inflation for the past 2 years has been an ongoing problem. There's been a stagflation where there's been no movement whatsoever in prices. But I'm going to explain to you guys in layman's terms and break it down for you guys. And I'm going to generalize this around the United States economy. Okay? So stalled inflation this year hasn't derailed the Federal Reserve's plans to eventually cut interest rates. And as I said, their interest rate target, guys, was 2%, right? 2% has been their target. But here's the problem. It's been over 2 years, okay? 2 years that we haven't really seen much movement with inflation, and it still hasn't arrived. So as much as they said, you know, we're on the way to reducing inflation, blah, 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 we still ain't seen nothing. Now, the slowdown might simply be delayed, but some analysts worry it's not going to happen because of changing dynamics in the housing market. If so, that would significantly weaken the case for lower rates. Now, housing has played a large role in inflation of recent years because its costs rose so much and carried such large weight. It's actually 1/3 of the consumer price index, guys, okay? And around 1/6 of the price index of personal consumption expenditures, which is the Fed's preferred inflation measure. Now, it is also in theory predictable, guys, okay? Because the government statisticians, don't use home prices to calculate inflation because a home is partly an investment. Instead, they use monthly rents to capture what tenants pay to rent, or what tenants may pay, for a home or an apartment, and what a homeowner would in theory pay to rent for their own home. Now, look, guys, right now, across the world, it doesn't just have to be America. You tell me right now, you tell me in the comment section, you ask yourself, is the rent in your area going up or is it going down? Is house prices going up or are they going down? What's the rental market like in your country, in your city? Has it been going up over the past 6-12 months or has it been going down? Now, market rents, okay, rents on newly signed leases surged 3 years ago, reflecting the unusual demand for more space unleashed by the pandemic. Strong income growth and historically low inventories of homes for rent or purchase, which a single family home rents rose 14% in 2022. Now, guys, that short passage that I just read to you guys, I wrote this down because I really wanted you guys to hear this message, okay? Since lockdown, there's been more demand for space, okay? There's been a more demand for space, but because of that also means there's been more developments built. Look around. I live in Dubai and I can tell you Every other day, they're building a new house. They're building a new apartment. You guys tell me, watching this video now, have you seen more homes, more apartments, more flats, more buildings being constructed, or are you seeing less? Because with that being said, you could understand now what I'm reading to you guys is a reflection of what we're seeing. And that is that because of lockdown, there was a more demand, a bigger demand. I mean, remember guys as well, lockdown, a lot of people had babies during lockdown, probably more than usual, right? So a lot of people have been wanting to get a new home. So because of that, this has been a knock-on effect in the economy. It's resulted in them simply building more developments. Doesn't mean that they've been filling it, but because they've been building more developments, they've also been charging you guys more. They've been charging you more. Like I said to you guys, single family homes rent. The rent for a single family rose 14.2% in 2022. Okay. Now, year on year, rent growth slowed to 3.4% in February, which reflecting, it's increased competition from the new apartment supply. So it's reflecting the fact that we are understanding, guys, that, as I just said, there is a higher demand because people have been wanting their own spaces. But sometimes, guys, when the demand, or not even sometimes, when the demand outweighs the supply, the value of an asset goes up, okay? But in this instance, here in Dubai, for example, you see a lot of new homes being built, but you don't see a lot of people filling those homes. I've seen a lot of projects that have started, haven't been finished. A lot of projects have started, they've been built, the community, the development's been finished, but they haven't filled that project with homes. They haven't filled the project with tenants. So there is an ongoing rental crisis around the world, okay? Right now, I'm from London, right? London house prices, rental market is extremely high. Here in Dubai, the rental market is also high. So it's important to understand. In America, the reason why we're seeing this and the reason why I'm able to get those statistics for you guys kind of shows you that this is something that we're experiencing all over the world. Now, with that being said, I did want to share with you guys the fact that we do have to understand now, and I found this article that I want to share with you guys, if I can share it with you. This article here. Now, this article, guys, was about the week ahead for Forex, bonds, and the US inflation data, which, of course, has been widely awaited. Now, it says here, US inflation data for April on Wednesday are likely to be the highlight of the week. Markets will be looking to see whether inflation has started to turn lower after 3 straight months of higher than expected readings, and whether investors are justified in pricing in a high chance that the Federal Reserve will cut interest rates in September. Now, I also want to show you guys here, if we scroll down, we can see that we've got information about the Eurozone as well as every other country. So let's just briefly speak about the Eurozone. It says investors will scrutinize upcoming data in anticipation that the European Central Bank will likely cut rates in June. Markets are pricing in a high chance of a June rate cut following recent signals by ECB policymakers and after Sweden's Riksbank this month began cutting interest rates. Though there is uncertainty about how much they will cut rates after that, in that light, data on inflation, wages, and the economy will be key. Now, if we go back over to this article, guys, we can see here that the analysts forecast the inflation reports to remain the same. So if they do actually come out and they remain the same, well, what we can see here in this passage is it says here, investors will be looking to see whether data confirms that the Eurozone's nascent recovery is gathering steam. So what we're trying to understand here, guys, is if the inflation goes down, interest will go down with it, right? But please understand, the cost of living is going to go down, which means it's going to become more affordable for everyday Joes. If this does not happen, investors are going to panic. Why are they going to panic? Because quite simply, guys, right now what's been happening is a whole chain has been disrupted. Why? I'll give you an example. Let's say you're a homeowner and you want to rent your home out to a new family just moved from France. They're now living in UK, right? They've been living in your home for the past 6 months, but now that lockdowns come around, they've been made redundant. They're unable to keep up with their repayments for you. In exchange of them not being able to keep up their repayments, you may also own maybe, let's say, two, three, or 10 properties. Because you've got multiple properties, or even just that one income, okay, that one property that's giving you an income, because they're no longer paying you, you're also going to have to use your own savings, your own source of income, a separate source of income, to keep up your mortgage repayments if you've got your property on a mortgage. So sometimes, in some cases, okay, I've worked in real estate before in the past. I used to be an estate agent, which feels like a lifetime ago. But I've spoken with homeowners who have been relying on the tenant's income to pay their mortgage and also to live. So it's really important, guys, to understand that this is not just a knock-on effect for the rich, okay, and the millionaires and the billionaires. This is a knock-on effect from the fact that at the very bottom, if there is a problem, that goes up the chain. So if inflation cannot get better, if the cost of living cannot come down, then there is going to be a continuous knock-on effect of the homeowners, okay, investors, as we call them, having problems. Investors may be having to go bankrupt. Investors may be having to sell their properties. Investors may be having to reduce or release some of their assets because there isn't a demand for them. If they don't have the right people paying the right prices in order for them to make a profit, it then becomes worthless. It becomes a depreciating asset. So it's important to understand here, guys, inflation, interest rates, these are the two most important things when we think about trading Forex. Notice, guys, how long? We're 15 minutes into this video, okay? If you're watching this and you've managed to get here so far, pat yourself on the back, make sure you smash the like button and subscribe if you haven't already. But what I want to explain to you guys is 15 minutes into the video and we can already understand now that if inflation and the interest does not go down, this is going to be worse. This is not going to be better, this is going to be worse. Meaning, we now understand that we can have a bearish mindset on that particular country. For example, in this instance, the Eurozone, which would be the euro, the dollar, which would be the United States. We would automatically now start thinking about having a bearish mindset. I'm not saying that we need to jump into a trade and start selling. No, I'm saying that if we can put some of the pieces to the puzzle, we can start to understand that really, when we look on the charts, there might be a significant area 500 pips above, 200 pips above, and that might be the area that we sell from. We all know that the news is an excuse to pump the price. The thing that runs the markets, it's not interest rates, it's not inflation, it's liquidity. Liquidity is what drives the markets, and you'll notice when the money is when the markets are stale, okay, what are investors doing? What are central banks doing? They're buying gold, they're buying cryptocurrency. They're putting their money and keeping their money where it's liquid. They're keeping their money where it's moving. No one is simply holding on to a depreciating asset saying, damn, I'm wishing for the best. That's not happening, guys. Liquidity will always give you the answer to where you need to be buying or selling or taking profit. So with no further ado, I do want to share with you guys what I'm talking about on the charts. And actually what I would like to do is I'd like to show you guys about the bonds. So let's do this. Let's go on to the bond market. Okay. And remember, if bond prices go up, that means interest rates have gone down. Now, I've spoken about this before in the past. I'll tell you guys again. We have the US 10, okay, the US 10 government bonds and the US 10Y. The US 10Y are the bond yields, which are inverse to the bonds. So if the bonds go up, the bond yields go down. Now, the bond yields, okay, they are connected to inflation and interest rates. So if the yields go up, so does interest rates as well as inflation. If the yields are going down, that means because inflation as well as interest rates have been going down. Now, of course, if we remember what I covered at the start of this video, which was looking at the inflation, the core inflation for the United States dollar, it's to be expected, forecasted, that we will get a reduced rate, okay, a reduced rate of inflation. If that happens, guys, that means we do want and we will see the yields pushing lower. If the yields come down, which to be honest with you guys, when we're looking at the charts off of a weekly time frame, we can kind of see why the yields would push down lower. I've covered this on my Market Mondays video, so be sure to check out that episode for more information on the yields. But just to kind of retouch this and go into it in a bit more detail, you don't really want to be looking at the yields on the hourly time frame, guys. You want to look at this on a higher time frame. Why is that? Well, I'll give you an example. The inflation report, CPI data, is released once a month. Once a month. So if that's released once a month, as well as the interest rates released once a month, we have to understand those are the two factors that resemble the bond market. So because those two things resemble the bond market, that means that there's not many factors that are going to conclude to the strength or weakness of the bond market. Therefore, we should be looking at the bond market on a higher time frame, because the news results that can impact the decision on whether the bonds go up or down only comes out once a month, literally once a month. So we look at the bonds on a higher time frame so we can get an indication. And in this instance, if we do get price coming down lower, we do have at the 4.631% line, this blue level here, we do have a structure level, a significant level of structure, and we have seen price pushing down lower. If price does continue to push down lower, remember guys, the news is coming out on Wednesday. So we would have to wait until Wednesday to see what happens. But if this does push lower, this of course is going to send the bond markets higher, okay? The treasury bonds will push higher, and when we're looking at the chart off of a weekly, we can also see and support a further indication to the upside, because we've got two confirmations here. One, we've got a Fibonacci where we've had a nice reaction from the 79% and now from the 62%. And two, the second confluence is taking on board the forecast from the analysts. I'm not saying the forecasts are true. I'm not saying what the forecast is from the analysts is going to come true. I don't know. Okay, I'm also not a financial expert, so any information you hear from me, guys, before you make any financial decision, always consult a financial expert. So with that being said, my personal opinion on where I believe the bond market could go is up, based on the fact that we've got a Fibonacci from a technical analysis which is supporting a higher price. Number two, we've also got the analysts forecasting lower inflation, and number three, the US bond yields. The US bond yields look like they want to come lower. And because I told you these are inverse, guys, if this one's going to come down, the other one is going to go up. It's that simple. So because I can see a buy on this, it would give me more confidence to see a sell on the other. However, I would need to take both of them, separate them, and take them both for what they are individually. When I look at the US yields, when I look at the bond yields, I don't look at them thinking, well, the bonds are bullish, so this must be bearish. I look at the bond yields for what they are, and I say, hey, are you bearish or are you bullish? When I look at the bonds, I look at them exactly the same as I would look at the yields individually. That is going to give you a clearer way, guys, of making a decision, a non-biased decision on what your analysis will be for those in particular instruments. So the key here, guys, because I don't want to ramble on, but when you're giving away value like what I'm giving, sometimes you've got to ramble, okay? The key here to understand the significance on how you can make money, as what you all have been waiting for. If you've got to this part of the video, guys, this is the best part of the video. Be sure to smash the like button. If you guys have got to this moment in time, you will understand this one thing. The bond market is the Mac Daddy. The bond market is the Mac Daddy. Meaning if the bonds go up, the US dollar is going to follow it. The bonds are the Mac Daddy. I can't say it any better than that. If the bond market goes up, guys, the dollar is going to follow it. And here's the best thing about that. The dollar is not going to follow it simultaneously. Unlike when you look at the DXY against Euro USD or GBP USD, and when the DXY goes up, those go down. No. When the bonds go up, the DXY has a lag. It's a lagging instrument. It lags behind. Sometimes it could be by a few days. Sometimes it could be behind a week. Prior to lockdown, what I noticed, and even during lockdown, is that the bonds would actually have like a day lag. So if the bonds pushed up today, within a 1 to 3 day window, the dollar would follow it. Ever since we've had lockdown, we've had growing problems with an all-time high inflation. Remember, at one point, guys, inflation was the highest it had ever been in 75 years. That is longer than maybe you, your dad, or your grandma is. You understand? 75 years, that was a huge problem. So since then, there has been a lot of manipulation. The banks have had to pump money into the economy in forms of stimulus checks. In the United States, in UK, they had bounce back loans. They was giving money to businesses to help them, to prevent them from going bust. So there was a lot of money pushed into the economy, which is a form of a stimulus, okay? We call this quantitative easing. Quantitative easing is when they're printing money and they're throwing it into the economy. That is a revival tactic. It's a tactic to revive a heartbeat, okay? So with that being said, if the bonds are going to push higher, we need to understand that the dollar is going to rise with it. So if we just go back over to the bonds, we can see here, I'm going to go on a higher time frame. Let's go on a monthly time frame. The monthly time frame shows you, but we've been in an insane range here, okay? But what's important to understand here is when we go back over to the dollar, we can understand the dollar's also been in the range for some time as well, okay? So until we have a clear indication on either one, okay, either the yields or the bonds where we're looking to go, that is the only time that we can get a clear long-term trade. Now, for those of you who say, Cavell, look, bro, I don't really trade on the higher time frames. That's okay. That's fine. But if you can understand the higher time frame picture, then you can go down to the smaller time frames and find an entry. I don't really trade off of the weekly or monthly time frame. I don't. But if I know the weekly time frame is bullish and the daily time frame is bearish, that to me tells me that the daily time frame is pulling back in order for it to become bullish. So you use the higher time frame to find the direction, and then you use the smaller time frame to find the entry. So again, going back over to the bonds, okay, I would like to see the bonds push up, fill some more of this imbalance, but take out the high. The bonds have to go somewhere, but historically, the bonds have never really gone anywhere. The highest they've gone is up here. This was the all-time high at 115. So essentially, we need the bonds to come out of this range, to break this range. If it could break the range, the bonds could give more clarity in giving more strength to the dollar. But again, one of the biggest concerns we have right now in the United States is not just inflation. It's not just the interest rate. It's actually the rival of the BRICS movement. The BRICS movement, which stands for Brazil, Russia, India, China, South Africa, okay? The BRICS movement, for those of you who don't know, is a movement that is based on giving clarity and giving back value to currency. It is the association of gold to a currency, meaning they are creating a currency that will be backed by a real-life tangible commodity, in this case, gold. Because of that, this, of course, is never going to be something that the Federal Reserve is going to accept or just or simply smile at, because this is something that actually could change the game completely. At the moment, we all have money. I live in Dubai. My dirhams are worthless. Your pounds are worthless. Your dollars are worthless. Your euros are worthless. The only use or the only value that you have for your currency, the only value your currency has is the value we give it. If everyone decided to stop believing that any currency, let's just say the dollar, for example, if everyone started to dissociate the dollar as valuable, the dollar would soon become invaluable. But because we believe we need $100 bill to pay our rent, to do this, to do that, which we do, okay, that is the reason why the dollar and fiat currencies right now have value. But the moment you can back your currency with a commodity, a tangible asset you can feel, you can touch, you can smell it, you can lick it, okay? There's the moment you can combine a currency to a tangible asset, that changes the game completely. So, of course, with the BRICS movement being a huge competitor, with cryptocurrency being a huge competitor, it's very unlikely, if I'm really honest, that we're going to see the dollar make an all-time high. It's very unlikely. I believe these currencies are on a ticking time bomb, every single one of them. every single one of them is on a ticking time bomb because they're all trying to adapt to cryptocurrency. They're all adapting to digital currency. We're in a much more technology-driven environment now than we have ever been. If we look at the highs here of the United States dollar, 164, that was back in 1985. I don't think we'll ever get there again. I think those days are long gone. I think really there's two ways to look at this chart. You can look at this chart and say, okay, after this, we must have had a great recession, a reset. Price was trying to get back up there. In 2002, you can see price came down. We had another recession in 2008. Really, you could look at this chart as being bullish, or you could look at this chart being bearish. Why do I say that? Well, because this was the high, this is the second high. Now, we can see this as, we can see this here as a high, down here as a low, and then a lower high, then a lower low down here. What's going on the mouse? Okay, so let me draw it for you guys. That would help. So we can see this being a high. This could be the low. That's not the one. All right, cool, yeah. We can see this here being the high, that being the low, this being the lower high, this down here being the lower low, this here being the lower high. If, let's turn this off, if price comes down to now make a lower low, okay? If price comes down here to make a lower low, that would, okay, resemble a bearish chart. So yes, we can get caught up in what's happening at the moment. I know we could be a long way away from this, but guys, there's two ways to look at this chart here right now. If we go into the daily time frame, yeah, sure, we can say the dollar's rising, it's been bullish, blah, blah, blah. But if we understand what's happening in the world, we can't ignore the fact that actually there has to be, and this is a ticking time bomb for the dollar to explode. Cryptocurrency at the moment, okay, has taken such a huge center stage that you've had central bankers, okay, you've had investment bankers, owners of investment banks like Jamie Dimon, you've had world-renowned speculators, George Soros, Warren Buffett. These people have all come out and they've all pretty much pissed on crypto, more specifically Bitcoin. They've all told you Bitcoin is a waste of time. Bitcoin has gone to $70,000. If you invested $1,000 3 years ago, your same currency, your same $1,000 would be over $10,000 right now. So please understand, there is no other asset in the world that has done anything remotely close to what Bitcoin's done in a short space of time that it's done. Therefore, it is something that investors, institutions, organizations, governments, they cannot ignore it. They can no longer ignore it. When Barack Obama was in the seat, he once mentioned the fact that he didn't like the fact that people having crypto wallets was like walking around with a Swiss bank account. This is what he said. He said this in an interview. He said, having a cryptocurrency wallet is like walking around with a Swiss bank account. And all that tells you is essentially the hidden message is him saying, hey, we can't control how much money people are earning. We can't control what they're spending. We don't even know how much they have. That is not good for us. Why? Because each economy is built on debt. And without them having debt, without them being able to keep you under the thumb of being in debt, they can't control you. So it's really important to understand, guys, that as much as, we are looking at Forex, we are understanding, what certain things, what certain meanings or what certain data what certain data can do to the charts, we do also have to understand the bigger picture. We have to understand the outside factors, the outside noise that can implement or that can change the direction of the world. Okay, cryptocurrency is changing the direction of the world. It's not just changing the direction of finance. Okay, you can now order a taxi by paying for crypto. You can walk into a supermarket and leave without paying via crypto. These are things that are changing the world, guys. It's changing the way you transport. It's even changing the way how people communicate. And it's changing the way how people purchase products as well. So it's really important, if you've come across my YouTube channel and this is the first video you've watched, or whether this is the 100th video, 50th video, who knows? My point is this. You need to be able to take information away and practice it. How do you practice information like what I've said today? Well, number one, you get a notepad, you write down some key topics, some key points to understand. Some of those key points is the fact that we've spoken about interest rates, we've spoken about inflation, we've spoken about the bonds, the bond yields, what effects they have on the dollar. And then we want to start to back test those. We want to start to go back 5 years on the charts. We go back, we compare what the bonds have done versus what the dollar has done. Has the DXY followed the bond market, or has it not? Test what I'm saying, guys. Of course, okay, I've got over 7 years of experience. I've tested what I've said thoroughly, but I urge you to do your own readings, to do your own chart readings too, because there's nothing better than a euphorical moment of saying, I got it. It makes sense. I see it. I actually see it. I no longer need to believe it. I see it. And when you see it, guys, there is no better feeling. So to conclude, guys, I want to wrap this up. I want to show you guys what we could expect here on a smaller time frame. As I told you guys, liquidity is the most important factor that's driving any market. Okay, liquidity, that is what everyone cares about, is the money. Now, at the moment for the dollar, we do have an equal high inside of this area here. So with this equal high, that of course means that there is money inside of this area. There's money up here. Oh, there's money up here, and there's also money above this yellow zone as well. So there's reason for prices to push higher, but there's also reasons for prices to push lower. This is a game of equal highs versus equal lows. For all of my students out there, you will know exactly what I'm saying to you right now. This is a game of equal highs versus equal lows. Is there more equal highs or are there more equal lows? If there are more valid, equal lows than equal highs, that means there's more money below than there is above. And if there's more money below than there is above, that means price will come down rather than going up. So guys, look, I'm going to cut it there. I don't want to ramble on too much. Okay, I did want to show you guys some other pairs, but I have broken down inside of the Market Mondays episode 6 my thoughts on the currency pairs, so you guys can have a look at those to see exactly what I'm thinking. But this video today was to speak to you guys about inflation, about interest rates, and about how you guys can implement the fundamental aspects into your trading. For more information on mentorship, if you guys are wanting to have a free consultation, guys, if you guys are wanting to develop your trading skills and take it to the next level, you can book a free one-to-one consultation with me by clicking the link below, where I can show you what I do, how I do it, but most importantly, how I can benefit you. With that being said, I appreciate you guys for watching, for staying the course. The most important thing, guys, is that you're learning with Vel, which means you guys are learning to make some money. You're not here to waste time. If you start here throughout this video, you're here to really put in those hours and to change your financial future. So comment below, guys. Comment below with a green heart if you guys managed to watch through the whole video, and if you guys enjoyed it. Let me know what pairs you would like me to maybe break down in the future, or maybe what questions you have, or any type of reviews you guys want me to do. And yeah, I'm out, guys. Thanks for your time. Always remember, every day is money day. Peace.